So having a mortgage is essentially one of the biggest debts a person will have in their lifetime. It's a homeowner's dream to fully own their house, not just some part of the equity, and basically live stress-free, knowing that they're debt-free. And while doing that, you also want to pay as less interest as possible. So how do you do that? Hey guys, welcome back. My name is Fyzee, and today we're looking at some ways to pay off your home loan quicker. As always, we are talking in a general sense only. This is not financial advice. I am not a financial advisor, but I have worked as a mortgage broker in the past, and I have dealt with hundreds of customers across Australia. And these are some of the things that you could do. The timestamps are in the description as well, and you can flick through them quite easily. Number one is making extra repayments. Now, this might seem super obvious. To pay off a debt, obviously you want to pay extra. It seems like a no-brainer, but why is this so important? Well, this accelerates how quickly you pay down the principal, and the lower your principal, the lower interest you get charged. So let's look at an example. For a standard 30-year loan, the interest rate may be 2.7%, and let's say that your balance is about 500k. Your repayments on 500k will be 2,028 per month. And based on this, you're paying a total of 730k over 30 years or $230,000 worth of interest over those years, meaning you pay $1.46 for every $1 that you've borrowed. Now let's add in the extra repayments. Let's just say that you can pay an extra $100 per month. Based on the calculations, you will save 2 whole years of your home loan. Now let's make it $200 extra, and you have just saved 4 years of your home loan. But extra repayments can be even more effective if you combine it with number 2, which is increasing the frequency of repayments. Now, if you didn't know, paying fortnightly is better than paying monthly on your home loan. And better yet, paying weekly is better than paying fortnightly. The reason why is simply because if you just pay monthly, there's only 12 times a year where the principal is getting reduced. Whereas if you pay fortnightly or even weekly, the principal is continually getting reduced. And basically you're making your repayments at a much higher interval or frequency or whatever you want to call it, and the interest is being accrued less. Now just keep in mind that the interest is actually accrued daily. And what that means is that the banks work out how much interest you will pay each day, then they add it all up and charge it to you at the end of the month. So if you're only making monthly repayments and you're only paying your mortgage once per month, the interest gets accrued on all those days and you end up paying more. But if you're paying fortnightly or weekly, you are decreasing the principal much quicker, and the interest is being accrued on a lower balance each time. I really hope that makes sense. If you still didn't understand, please drop a comment down below and I'll explain it to you. So basically a thing you can do is, let's say you get a home loan and the bank says that you need to make monthly repayments of $2,000 per month. Instead of doing that, you can set up your own direct debit and you can make fortnightly repayments of $1,000 instead. Now this will do a few things for you. Firstly, you have just increased your frequency of repayments and you're paying your mortgage off a lot quicker, but you're also making 2 extra repayments per year. But how? Well, if you keep paying $2,000 per month, you'll end up paying $24,000 per year of repayments. But if you pay $1,000 per fortnight, you'll pay $26k per year. So basically that's a $2,000 difference. Now this is quite easy to do because psychologically we think that a month has 4 weeks, therefore 1 month will have 2 fortnights. And we can easily set it up, but in reality, a month has about this much weeks. Now, a good thing about Australia is that some of us get paid fortnightly or even weekly, which is great because we can easily sync up our repayments with our pay period and essentially prioritize the mortgage because our aim is to just kill off this debt. Now, number 3 is the credit card plus offset account strategy, which is quite useful. But before we go into that, please leave a like if you've learned something so far. Now, just a quick disclaimer about this. This strategy is not for everyone because not every single person out there is going to be good with credit cards. So just keep that in mind. Now, basically how this works is that you get your pay deposited into your offset account and you let your offset balance build up over time, and just make sure that you don't spend the money in your offset account. So then when it comes to your everyday spending, when it comes to bills, groceries and all those expenses, use the credit card instead and pay your credit card off just before the interest-free period ends on your credit card. So this will again do a few things. Firstly, the money is sitting in your offset account and each day it is reducing the amount of interest that gets accrued on your mortgage. Now, if you would have spent this money through your offset account instead, you would have ended up paying more on your mortgage. And secondly, since you are paying your credit card off on time every single month. You're paying no interest on the credit card. Plus, you may even get some rewards points on the credit card as well. And thirdly, since most banks offer credit cards with a package, and in that package an offset account comes into it as well, your credit card is basically covered in that package, which means that you will pay no annual fees for the credit card. You just pay the one annual fee to package everything together. Now just keep in mind that whether you pay extra on your home loan or keep money in the offset account, you're pretty much saving the same amount of money. The only minor difference is that with an offset account, usually speaking, since it's part of a package, there may be an annual fee that the bank might charge you. Or if you don't want the offset account and you don't get the package and just go for a basic loan, which a lot of people do, you can usually pay extra, but there might be a redraw fee if you want access to those funds. Speaking of different types of home loans, method number 4 is fixing your loan or even splitting it. Now, do not make this decision blindly just because interest rates and fixed rates are at an all-time low, and just because you want to save money, because these fixed rates have some negatives which you need to watch out for. So let's say that your loan is 500k and you want to do 2 splits. You might want to do the first split with 400k with a super low fixed rate and the second split with a 100k variable split. And basically your strategy is to pay as much as you can onto the variable. And how you'll end up saving money is that the bulk of the loan is going to be fixed at a super low rate while you pay extra on the other. Now just keep in mind that paying extra on the fixed portion of the loan has restrictions. If you want to know more about fixed rates, variable rates, and split home loans, I made an in-depth video about this. So check it out. There should be a link in the description and there should be a pop-up on your screen right now as well. Now last and final method is number 5, which is to refinance your mortgage altogether. The interest rates over the last few years have fallen to record lows. The banks have put out some of the lowest rates in their banking history. And if you've got a mortgage, it's very important for you to capitalize on this opportunity. If we go back to the previous example of a $500,000 mortgage at 2.7% and 30 years, if you refinance and get a rate drop of, let's say, 0.2%, so your interest rate is 2.5%, your repayments will drop down to $19.76 per month. That's a saving of $52 per month. It's not a lot, I know, but the crazy thing is that $50 saving, if you pay that into the home loan monthly as you were before, you can pay off your home loan in 29 years. So basically you're getting a 1-year saving just for a measly $50 repayment. Now, if you're thinking that it's not really worth the hassle saving like $50 a month, just remember that banks are giving out refinance cashback offers at the moment, and a lot of the times the actual refinance costs less than the cashback. So basically speaking, you're getting some extra cash just for refinancing, and you can just pay that back into the home loan. Things have changed quite a lot. Just a few years ago, your rate was considered good if you were paying somewhere around 3.5%. But now it's quite a high rate, even for investment. Now, I'm fully aware that some people might say, why would you pay off your mortgage right now when it's cheap debt and you can just invest the money elsewhere into an index and basically make like 7% per year, so why pay off the debt? Well, it really just depends on your goals and what you are actually trying to achieve. Some people just want that peace of mind knowing that they own their home fully and they don't have to worry about the mortgage at all, so it just depends. So there it is, guys. Hopefully you found this video helpful. And if you need more clarity around fixed rates, split loans, or variable rates, click the link in the description and watch the video. I think it'll help you. So hopefully you found some value. If you did, please like and subscribe. It really helps out. I make regular videos on home loans, investing, and pretty much everything to do with personal finance. So if you're into that, please stay tuned and I'll see you in the next one. And for borrowers, and if you've got a mortgage,